On today's show, 3 questions. Number 1, is Jerome Powell listening to our podcast? Number 2, how will new policy impact the economy? And number 3, what happened on episode 500 of the student loan saga? Welcome to Dentist Money's 2 cents, where we have dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are, Rabih.
What's up?
Just us again. People are going to get tired of us, I think. We gotta get back into the rotation of the three people.
In.
Yeah.
I'm hoping that by this point, whenever they hear that's just the two of us, they have like a pen and paper because they know it gets technical.
They're like, well, Robbie's got to carry Matt even more this time. We don't have a third person. No, we're going to get back to the threes here pretty soon, the trio. Just so people know, the reason why this happens a lot is we're kind of in the middle still. Well, I guess we're wrapping up our kind of beginning of the year progress calls with clients, and it's just more difficult to get advisors on the horn, as they say. So it's just you and me, Rabih. Excited to be here as always. The first question being, Rabih, is Jerome Powell listening to our podcast?
I came to this conclusion after listening to the Fed meeting earlier this week. And Jerome Powell, the chair of the Federal Reserve, said one sentence that resonated so much that made me jump to this conclusion. We say that we help dentists navigate all the noise, right? What Jerome Powell said, and I quote, "We are focusing on separating the signal from the noise as the outlook unfolds." Coincidence? I think not.
Coincidence? I think not. I would not be shocked. I'm going to have to text him and say, Jay Powell, are you listening to 2 cents? Yeah. It would make sense. I mean, we break strikes. We change policy. Every time we talk about student loans, which we will today, something else happens. Like, I think we are having a bigger impact than we thought.
It is. It's wild. But all jokes
aside. Coincidence? I think not.
I think not.
I love that.
All jokes aside, it was a very big week for the Federal Reserve. And not only because, equity markets have been selling off lately, but because, as they do every single quarter, the Federal Reserve issued the summary of economic projections. They're going to tell us what they think how the economy is going to evolve in terms of real GDP, what unemployment is going to be like, what inflation is going to be like, and what the interest rate is expected to be for the rest of the year. So it gives us lots of information. The market reacts a lot. So let me walk you through them, and we will see whether that's good news, bad news, and try to understand why the market has reacted the way it has reacted. So the last time we had these projections, it was in December. And for 2025 in December, they said that the GDP is going to be growing at 2.1% according to their expectations. Starting the year, our expectations were like, we're going to be 2.1, our target is 2. It's a really good growth. Now they have adjusted their target to 1.7% growth for the GDP, real GDP in 2025. And they also dropped 2026, 2027, all below 2% at 1.8, which is interesting because now you are still growing in terms of the economy, but you are growing below target. And the shift between a higher level of growth to a lower level of growth means that there's a slowdown in the economy. They might not be pricing in a recession because moving from the 2.1 to the 1.7 can happen in multiple ways. It could be just one bad quarter or a series of very minimal slowdowns that it doesn't really is considered a recession. There are multiple ways it can go through, but they are saying the economy is slowing down. And we're going to be growing below our target for 2025. Interesting, when it comes to the soft landing argument, there's not saying a recession is going to come by, but now the economy is slowing down. In terms of unemployment, their projection for 2025 is 4.3%. They're saying in 2024, it's going to be 4.4%. Not really much of a change, 0.1% increase. Then inflation, whether it is the headline or the core, it's going to be a little bit higher. So they were expecting inflation to be 2.5. They are saying that inflation is going to be 2.7 headline, 2.8 core. Economy is a little bit lower. That's what the number said. Employment kind of unchanged, a slight uptick. Inflation a little bit more stubborn, around 0.3%, a little higher than we expect, 0.3 points. Interesting. Given that...
Rabih, can I just address one thing and tell me if I'm thinking about this the wrong way? It just feels interesting to me. Like, are these really like they're it just feels like they're just reacting to what's happening. Like they're setting these targets, but their targets change every time they meet. And they're like, oh, you know what? Now it's 1.7. And then something will happen like, oh, you know what? And actually, no, our target is now 3. It just feels like it almost feels like they're having these meetings, and then tell me if I'm wrong. They have these meetings to appease the public, but every time they have the meeting and they're changing stuff, it's like they don't know any more than we do. They're just reacting to what's happening in the economy. Is that a fair?
That is fair, but also we are choosing our devil over here, or choosing the pill to swallow, because the opposite side of that, which what monetary policy was before Greenspan, they do not tell you what they expect is going to be happening. They do not communicate expectations into the market. And then instead of having everyone on common ground, we all share the same expectations. Everyone's thinking differently, and swings happen, and booms and busts happen.
Yeah,
So it is not really as much as them telling us how bad of forecasters they are, as much as it is part of monetary policy in this new age, 21st century monetary policy, where communicating expectations actually helps in fine tuning those swings and cycles to
it's more
the.
easing the public sentiment and just saying like communicating kind of makes it where we don't have as many big concerns and big swings and people reacting so aggressively.
Yeah, you could say that it makes markets more efficient. You could say that it smooths out economic policy. It makes it more effective because now, for example, the Federal Reserve doesn't really have to go in and cut interest rates for it to propagate into the economy. They can just communicate that are planning to cut interest rates, and market participants, whether it's businesses, consumers, etc., will start reacting preemptively, just like what we saw with how businesses reacted. We talked about it 2 weeks ago, how businesses reacted to the tariffs. They already started building up their inventory. This is part of really, and this is big in academia on how like proper way to propagate and communicate economic policy. So
Got it.
I know it is boring and they're giving us figures that change every single week, but it is important because those numbers go into the formulas that price stocks, that price bonds, that price interest rate, and you
Yeah.
update them every time.
No, that's a good. I'm glad we went over this because I think it helps. Again, I think it helps frame and give people context because I'm imagining people out there are listening and hearing that, thinking what I'm thinking, which is like they just keep moving the target. Like it doesn't like they're not projecting anything. But I see what you're saying, and that's important context of the information. The ripple effect of that information matters.
100%.
Yeah, that makes
100%.
sense.
So to go back to our table, they said a little bit lower growth, a little bit higher unemployment, a little bit higher inflation. Okay, what are they going to do about it? Previously, they have communicated that they expect 2 cuts of interest rates this year, 2025, 2 separate ones. Each one is around 0.25% or 25 basis points, one around the end of June, one around the end of the year. No change on that. So that is very interesting because they say we expect the economy to slow down, but we're not going to go and try to improve the situation because it's not slowing down too much that it requires us to intervene. That usually is not good news for stocks because if the economy is slowing down and you're not easing monetary policy by lowering interest rates, what are you doing? Why are
What are you even doing?
what are you doing? So in general, it should be considered as a negative sentiment sign, and we'll see how it'll pan out. Will the market diverge from the Federal Reserve like they've done in previous, remember when we were wondering whether it's going to be a soft landing or a recession? The market went in one way and their pricing, the Fed was communicating something else. Will that reemerge and create opportunities to like rebalance, etc., or will they stay on the same path? I checked the Fed funds rate futures, which tells us what the market expects interest rate is going to be. They are still in line with the Fed, where they expect 2 cuts. They slightly expect more, like between 2 and 3, but not really 3. So they are still aligned in their expectations, but as data comes in, that might differ. We went into the press conference after that, and it got really interesting because they're saying unemployment is higher, inflation is higher. Those usually go against each other. Like in severe cases, that's called a stagflation, where you have high unemployment, we're not even near a stagflation territory. It's just why are they both moving upwards together? They should move opposite to each other. And here's what they asked. They asked, do you think inflation is happening from the labor market? And Jerome Powell jumped on and said, you check the hourly wages. You check the difference between the jobs available and workers available. You look at the participation rate. You look at the unemployment rate. All of these indicators are telling us that the labor market is in balance, and it is not a source of significant inflationary pressure. So all this inflation that we are still seeing in the economy, their target is to get to a core PCE of 2, but the core PCE is expected to be at 2.8 for the rest of 2025. All of these data are saying this inflationary pressure is not really coming from labor, which is interesting because if it's not coming from labor, where is it coming from? I have
And
my own hypothesis.
when you say coming from labor, Rabih, what do you mean by that when they ask that?
Okay, so because the economy, like you can lose a couple of machines, right? You could lose a couple of, I don't know, valuations. Like you can lose the amount of money that's circulating in the economy. But the most important one to the economy is workers. If you lose workers, that affects the economy the most. Given that labor is the most important factor in determining economic growth or slowdown, and that's why we measure unemployment rate a lot. It is the one that is usually most responsible for inflation, known by the famous Phillips curve, right? So the idea is that when unemployment is high, aka there are a lot of people out there that do not
Looking
unemployment
for
is high
jobs.
looking for jobs, companies are not incentivized to fight for employees. They can always find employees. They don't have to pay higher salaries, and higher salaries mean higher discrepancy income, means people can spend more. That creates more demand, creates inflation. That's the
Got it.
core linkage. And when unemployment is really low, companies are fighting for employees and they are hiking up their wages, and you go into a wage spiral because once they make more money, they can spend more money. Once they spend more money, the stuff they're buying gets more expensive, which makes them demand more money. So that is why the relationship between unemployment and inflation is usually opposite. When one goes up, the other goes down. But now, since Jerome Powell is saying that labor market is not the significant source of inflation, that inverse relationship kind of is breaking down for the current time, because there is something else that pushing inflation up there, although unemployment is kind of flat or slightly ticking up. All interesting stuff. So if the labor market, unemployment is not the major source of the inflation that is still sticky, what is the major source?
Yeah.
A lot of talk went into tariffs, which we're going to get to in a second. But he also said that, and this is where he actually said that we need to separate the signal from the noise, because yes, theoretically it might be tariffs, but how much of it is tariffs really? They haven't kicked in until April 2nd. Where are we heading? He didn't give an answer. My hypothesis, and this is like between quotations, my own personal opinion, I think this is still from the ramification of COVID-19. We had supply chain disruptions. The world is not as globalized as it was in 2019. And because of that, those supply chain disruptions are still creating a supply side inflation in the economy that is likely lasting. That's my opinion of it. It doesn't say that we're heading into, you know, an inflationary problem, but it just says that we are now in a different world where the new rules, the new equilibrium, the new basis is different, where inflation is expected to be a little bit higher, etc.
Kind of like, I mean, same, you could argue the same thing with interest rates. Like we came from such a, like people think that interest rates are high, but it's only because we're anchoring to like insanely low interest rates. That was the anomaly. What we're dealing with now is not the anomaly. So it's to your point, Rabih, like I think COVID, interest rates, all the things anchored us to to a certain mindset. So now it feels crazy, where in reality it's like it's actually probably pretty normal. So you're saying on inflation, your hypothesis is just still remnants of what we dealt with COVID, which actually makes sense. I mean, there was such disruption there to say that it's just going to be, even though we've been, which is crazy to say, Rabih, we're 5 years removed from COVID, which is kind
Yeah.
of crazy from
And
the start of it.
when I say supply chain disruptions, I'm not saying that, oh, there are still goods, and it's usually goods inflation and services inflation. It's not like there are goods staying at ports. No, that is running
Yeah.
efficiently again. But a lot of international companies have been offshoring all their efficient production that's been happening to China to other countries. There are costs in there. Those get carried over and transferred to consumers, which shows up in inflation.
You're saying this, yeah, I see what you're saying. You're saying that the changes that were made because of COVID, because of what happened with COVID, we're still feeling those
Yes.
consequences.
Yeah.
Yeah.
They might be diversifying, but it's less efficient.
Yeah. I could
That
see that.
in a sense. Okay, I have still two more things about the Federal Reserve meeting before we jump into the next topic. They actually asked, so why do you expect GDP is like lower? Is it because of consumer confidence? And we have been talking about consumer confidence for a while. And it was really interesting to hear the Fed's take on consumer confidence. We say that consumer confidence on the podcast is usually a self-fulfilling prophecy, and if we take it for what it is, it slows down demand. People will start spending less. Companies
Yeah.
will fire people. Which
Talk enough about a recession, you're going to put yourself into a recession.
100%. And it was very interesting what Jerome Powell said. He said consumer confidence as a data point doesn't come from like an index. It comes from surveys. They are surveying consumers and they're seeing whether their confidence is high or not, whether they expect the economy to improve, whether they expect to get raises, whether they expect to spend more, go on vacations. This is how they collect the data. And he said, if we like take a step back, the quality of survey data has been different. Like, look at it from the other side of the coin. The survey data about how people were happy with the economy in 2022, 2023, 2024 was completely different than what the economy was. People were complaining, but they were still spending like crazy. And he brought that argument in, saying that, okay, consumer confidence might be down now, but the economy is still in a really good shape. And he started his speech with saying the economy is in a really good place.
But
very interesting.
Yeah, it's funny. I imagine people in 23 and 24, or even 22, whatever, on their phone, they go from clicking buy on Amazon.com and then closing out that app and clicking over to Twitter or X, and like, inflation is crazy. It's like, well, a lot of complaining, a lot of sentiment mismatching from what was actually happening, which is people just continue to spend money.
So yeah, exactly. So I think that the perspective that they're portraying is that, yeah, people were tweeting inflation is crazy a couple years ago while the economy was still strong, although there was a hint of inflation. Now people are tweeting recession and they're freaking out in consumer confidence while the economy is still in a good shape, although it slightly is slowing down. So a more balanced approach.
Yeah. And we are, like you said, we are seeing softening. We are seeing things slow down. Doesn't mean that could flip really quickly. But again, we are actually starting to see some legitimate data that's showing softening in the economy.
100%. So with that, he was like looking forward on like what will influence the monetary policy, how the Federal Reserve is going to react. And in his attempt to navigate the noise, he kind of summarized down four main policies that are important to the growth of the economy going forward. And he said there are policy changes in four main areas. It's trade, immigration, fiscal policy, and regulation. However, the net effect is what matters, and we are not in a hurry to adjust our policy stance. And that's why they decided to do nothing about interest rates.
Yeah, Jay Powell's been in a hurry to do nothing. He's never in a hurry. Like, come on.
It is.
Yeah.
And I really think that if they are choosing to stay data dependent, it means that the Fed is always going to be reactionary.
Yeah.
Like when the thing happens, they're going to intervene, which actually creates opportunities for whoever is on the sideline, but also do not be too much on the sideline because you might be missing out. So this is what Jerome Powell said. And I got really curious, which gets us to the second question of the day.
How will new policy impact the economy?
Because he talked about these four policies. And I'm like, okay, he's talking about net effect. Aren't they all going in the same direction? Like, let's dig deep. And this is where I get a little bit technical. So thank you for bearing with me.
People are like, now you're getting technical? What were you doing before?
I was just chit-chatting with you guys.
Yep.
He talked about trade, immigration, fiscal policy, and regulation. And actually, in summary, we're not going to go that deep, but how does each one of these actually propagate in the economy? Will that mean higher GDP and then thus higher stock market in a sense? Or lower GDP, lower stock market, but higher bonds? Like what is going to happen there? So let's start with the first one, and it is trade. We've talked about this so much before, so I'm not going to go into much detail. But when we're saying trade, we're talking tariffs. We are talking higher prices. If their tariffs in general just increase the price level. If there becomes a trade war where you retaliate, then they retaliate, then you retaliate, etc., that continuous increase of the price level is then at that point inflation. So trade policy, textbook wise, should cause inflationary pressure. Inflationary pressure means the economy is still growing, but it's not growing in real terms, in like your purchasing power or your real spending. It's just growing in nominally, like there's so much money chasing too few goods. That's the idea of policy. So if we want to assign a direction to trade, it's going to be upwards. A trade war is just going to grow the economy, but not in a natural way. It's like inflation is like a tumor. It's like excessive growth that doesn't really have any benefit. It
Yeah.
actually hurts you because it is growing too much. That is the first idea. The second one is immigration. And we just mentioned labor and the impact of labor on the inflation and the impact of labor on the economy. So when you think of immigration as deporting a lot of people, because this is the agenda the administration is pushing, you are reducing labor supply in the economy. And just on textbooks basis, we do not know what amount and how much that will actually have an impact. That's why we're waiting for the net effect. In theory, simplifying it, getting rid of labor from the economy, removing them from the economic equation, actually slows down the economy. So lower GDP in that sense, and actually pushes prices down because you have less people spending. That is interesting because it contradicts. Like when people are leaving, the economy is going to slow down. It's not like, and because the economy is slowing down, less people spending, companies will be less inclined to hire more people. So there's no
Yeah.
inflationary pressure. So immigration is a downward pressure to inflation. A trade war is an upward pressure to inflation. The economy is stuck in between. Okay, fiscal policy.
Is there sorry, really quick, Rabih, is there a case to be made on those two conflicting things creating stagflation?
Probably. And that's why they said lower GDP, higher employment, higher inflation, but it's not too severe to call it stagflation.
Got it.
And honestly, you do not want to push yourself there because in an environment where you are in a stagflationary environment, aka economists call it when the Phillips curve breakdown, aka the inverse relationship between unemployment and inflation breaks down, it's going to be very hard to put the economy back on. That's why in the 70s, the only way they were able to get out of stagflation was to like literally crash the economy into a recession. But I don't think we're even close to getting there. The third one is fiscal policy, which honestly, I think is fascinating because with fiscal policy, you can get to it different ways. When we are talking fiscal policy, we are talking about the government and how the government makes money and spends money. That is fiscal policy. We know that we are in a deficit situation with a rising federal debt, like national debt.
Decent amount of debt. Yeah.
Decent amount of debt, but it's scary. And like if it was a dentist, you would be worried about them.
A little
Honestly,
bit. Yeah.
yes.
Yeah.
So we know that we are
Yeah.
there.
Their burn rate would be off the charts. Yeah.
100%.
Yeah.
And now the debt rate is high, actually, because the US pays on interest servicing payments or interest expense more than it pays on anything else, more than we pay for military or more than Social Security, all of that. So it's not a healthy budget. They need a financial advisor. Putting that aside,
They need a Rabih. Yeah.
putting that aside, how do you, and knowing that you are starting from a position where you have lots of debt, what is the fiscal policy in place? Because the policy could be to spend more and try to grow yourself out of that through growth. The fiscal policy that this administration is pushing is no new taxes. On the contrary, lower taxes, but we're going to cut our spending like crazy. Enter DOGE, Department of Energy, Government Efficiency. So when the government decides to increase its expenses without increasing its revenue, they're gonna at least balance the budget in theory, hopefully go into a surplus, probably have a little bit of more cash in hand. Just like any human being, when they still have the same amount of income, but they decide to cut their spending, they are gonna have a little bit of savings left over. If you stop there and do nothing with the saving, just stash it in a bank account, that is bad for the economy. Because the economy is about all the money that is being spent and being circulated in the economy. If the largest participant of the economy, largest employer of the economy, which is the government, decides to just not spend money, although on pen and paper that's good for the budget of the government itself, it is bad for the economy as a whole because there's no money circulating. So the decision about what the impact of fiscal policy is going to be on the GDP, whether it's positive or negative, really depends on what they decide to do with those savings that they come up with. Elon Musk was saying in the amount of like $1 trillion, 1.5 trillion in 2026's budget. Interesting, because if they just stack it in the economy in a bank account, the economy will go down, which goes against the trade war, which goes kind of in line with pushing people out. So it's really, there are so many moving things that you can't really know what the net effect is going to be like. And that's the uncertainty. And hypothetically, what they could do with that money. As a financial advisor, what do you think they should do? Like if a person has so much debt and they decided to save some money.
I'd say it's a tie between take a killer trip and Bitcoin. You're taking a drink right when I said that. That's a problem.
I did not expect it to throw a joke in there. Crisis averted. So there was like, I don't know, more of like populist media stuff that, hey, let's give $5,000 checks to everyone from the Doge savings.
I saw that.
Right? Personally, I don't think that helps because that just exuberates inflation. Probably pay down your debt so that your biggest expense is not on interest payments. If they end up doing that, the economy is still going to slow down. We might go into a recession for like a year, but on the long run, the yield curve will actually have much lower yields on the 10-year and on our mortgages, because when you are paying, it's kind of taking the short-term hit. So on the long run, you are in a better position. This is what would translate into let's save on expenses, balance the budget for a year or two, create surpluses, and then use those surpluses to pay
it down,
pay a little bit of our debt. That would, yes, will hurt the economy for a year or two, but that on the long run would instill stronger confidence in the US as a global currency, in the US's credit worthiness to pay down back its debt. It will lower long-term interest rates because those are, reflect uncertainty about the future and kind of put us in a better position on the long run. I do not know. This is where it gets a little bit political. This is, in theory, the proper way forward, but with an administration. But with an administration that has a limited time frame in office of 4 years, that it might risk not taking that win for themselves, but for the next administration, I do not see how that would propagate. But it's interesting on how fiscal policy might go. The economy is still in a good position, so if they decided to slow down the economy because they're doing cost savings and try to fix the budget of the government, why now? It's better to do it now than to do it during a recession.
Yeah.
That is the idea.
That is the interesting part of this, though, on the political side, is the fact that he is a lame duck president, right? Like, let's be honest, he's not going to have another, like, this is his final stand, which I guess, depending on which way you look at it, could either be a good thing or a bad thing. But it does add an extra layer of complexity to this. To your point, he's not shooting to be reelected. He's not trying to get like narrative type wins. Adds a whole layer of uncertainty to this whole.
Yeah, like because there's a personal legacy involved, would you rather not do the most optimal decision just so you can secure the win in your term? That type of conversation.
Yeah.
And we'll see how it'll pan out. We're gonna be here. We'll see how it
We'll
pans
be
out.
here. Yeah,
we'll be here. The last one is regulation, and it kind of hits on what you are discussing. But in theory, regulation should be stimulating to the economy, because especially in a country like the US, and it really depends on where the regulation happening. So if it's a regulation on a new technology, that might be bad for the economy because you want to see how it pans out. And I'm talking textbook here. I know there's like ethical, especially with AI and stuff, or ethical concerns, but textbook economics regulation, especially on new emerging technologies, is going to be a net negative to the economy. It'll slow down. And technology, by the way, the growth of technology is deflationary. The more technology growth faster, the more productive we are, the more we can grow with the same amount of resources. That's deflationary. So they're going to act against each other. What they decide to deregulate is really what will determine whether the net impact is going to be up or down. Is it going to be old industries like energy and utilities and healthcare, or is it going to be new or even finance at this point, or is it going to be newer technologies, etc.? So, and really, we just went through this exercise and we really noticed that each one of these, according to the current narrative of the administration in Washington, they contradict, and we will have to see which one overwhelms the other to know what the net effect on the economy is going to be. And until now, it's uncertain. Kind of explains the uncertainty seen in the markets, the turbulence that we are seeing, because we do not know.
Yeah.
But that is
Well,
fine.
well, I mean, it is fine. And it's the only option we have, right? Just take tariffs to come back to that for a moment. You said it, to know what, like, we know the headline, we know what is being said from Trump, but here's some complicated parts of this. Just tariffs alone. What Trump says on one day, then what he says the next day, that can contradict himself. That adds uncertainty. But then you said it is, what's the reaction to these tariffs going to be? Like, from these other countries, we have no idea. So just that alone, just that one topic of the main ones you just went through, there's about 1,000 other different scenarios that can come out of this, depending on a lot of different factors. So it does make sense to say we have no idea. And it's easy for media outlets or whoever out there opining on this to be like, this X leads to Y. It's like, absolutely not. We have no idea
And
what
even
X
if
leads
we
to.
know that X is going to lead to Y, we also have a Z and a W and an A, and all of these might
Probably
either
a
lead
T
to Y
somewhere in
or
there.
not.
Yeah.
And those might either lead to the same Y or in an opposite direction that cancels out the Y. So we do not know because of all these moving parts.
Yeah. Before we jump to the last topic, I do this is a bonus topic because you mentioned something about the markets. I had a really interesting conversation. It was really there's a great opportunity to what's happening right now to show the power of global diversification. So really quick, because I think how this is all impacting the markets, obviously what we're seeing again, in media, markets are down, red, like chaos, all this stuff. But such a good reminder right now to remind people, the S&P 500 is not the market. It's not the market. And I'll give you this quick story from yesterday that is such a reminder of this. Had a client meeting, wanted to review some their investments, and she says, "I don't think I want to look. I don't think I want to see what's actually going on." But we like meaning from their investment accounts. It's just so scary right now. It's so scary what's happening. Like, I don't even think I want to see this. And I said, let me just look before I share my screen. Let me just see what the damage is, knowing that it's not going to be that much damage, and pull up her accounts. I'm like, hey, do you want to see? And so share the screen. Year to date, their portfolio is up. It was somewhat basically flat, but it was up about 1%. And they were like blown away. They're like, wait, how am I up? Like, well, it's basically flat. And they're like, how is that possible? I'm like, because the S&P 500 is not the market. We are invested globally. And if you look at what's happening in foreign markets, foreign developed, emerging markets,
They're
all
up
these
11% year to date.
they're killing it. Exactly. I mean, we're in a little mini lost decade right now, a very small window, but it's just showing the power of diversification. They were literally blown away. So I guess I say that to say, what you're seeing in the media does not necessarily equate to your investments, depending on how you invested, if you are diversified properly. So just a little side note there. We should have had that be the main topic. The
We make you money.
we make you money. No, it's not. It's not meant to be like, look at us, we're special. It's just a reminder to people that what you think is the quote unquote market is not the market. It's a piece of the global market. But for whatever reason, we're dead set on talking about it as if it's the only thing that matters when we're talking about returns and all this stuff. Any comments on that, Rabih?
No, I like it because our honestly happiness is dependent on the portfolio. But if we're looking at an index that does not mimic our portfolio, like what are we doing? Like
That's
we should actually follow our portfolio and see if that's up and down rather than the index that the market uses.
Yep, exactly right. Okay, last topic here. What happened on the episode 500 of the student loan saga? Rabih, this was you. Such a good question. So we we really just wanted to talk about, which I'm sure many of you have heard. Uh, uh, President Trump is expected to sign executive order No, I think he signed this yesterday, actually.
I
It,
did.
it happened yesterday. So we signed it yesterday to basically dismantle the Department of Education. So what, again, one of those things, what does this mean? We we don't really know. If you just hear that, you're like, oh, he's completely taking it apart. It's destroyed. It's gone. It's not that simple. They're certainly trying to downsize it, but there's going to still be pieces that'll be around in existence. But I think the natural question that comes up from this is, as they dismantle this, well, the Department of Education handles the $1.6 trillion, by the way, the $1.6 trillion federal student loan portfolio. So this brings up a huge question here. Earlier this month, sorry, I'm getting a call. Earlier this month, they've already kind of started this. So the department cut off half of its staffers. So they're down to 2,100 employees, basically. They were literally cut in half. So again, the question is, talk about, again, the student loan saga, the complications of student loans. I mean, we've talked about this so much, hence the joke of the 500th episode. We've talked about this so much of how complicated this has become. Uh, and I think it's only going to become more complicated. Senior Director of College Affordability said, exact quote, this would create chaos with this dismantling of the education department, which it's already happening. What Trump is saying and what his administration wants to do is this is a direct quote from Trump. He says, I don't think the education department should be handling loans. That's not their business. He wants another department to be handling the portfolio. So Rabih's got some
And
thoughts here.
dismantling the Department of Education is the way to do it.
I guess
Right.
so.
No, but that's not what I wanted to say. What I wanted to say is that now I love that the Federal Reserve has provided us with like a rational framework to look at. Dismantling the Department of Education falls under the umbrella of deregulation or regulation in the four policy changes he talked about, right? And it's honestly, you can compare it. Like, will the impact of whether it's positive or negative happen now or happen in the future? Like when you dismantle the Department of Education versus, for example, dismantling the Department of Transportation. And imagine all those people stuck at airports because the FAA suddenly doesn't exist overnight. Which one has a more prompt impact? Will it happen tomorrow? Like the fact that now we have to figure out how student loans are going to be paid or whether you're going to get any exemption from your student loans or, or getting them canceled. Will that have an impact overnight or will that have an impact that, kind of dissipates slowly through the economy? That's one. Two, will that impact be up or down? And that depends on how it's going to pan out. If they suddenly start demanding that everyone pays right now with retroactive interest, etc., I'm exaggerating, but this tells you that now people have less money to spend. Their discretionary income is taking a hit, and that might mean a slowdown because not everyone's going to be able to spend on everything. They have student loans to pay. But for example, a new plan comes out, or I don't know what happens, or they just get so lost because there's no government entity organizing this thing that it takes them a couple more months to figure it out. That gives people more time to, not spend on student loans. So it really depends on how it's going to be happening, but it falls under the deregulation aspect. And Department of Education is not part of the new technologies where it's secondary. Like I know it's important, especially from like a country's perspective, like the educational system in the US, etc. But talking pure economics, pure impact of financial markets and the prices, the impact is not gonna be really felt immediately.
Yeah. Well, this is, again, interesting concept here. We talk about, again, the fact that this is Trump's final, like he doesn't have a run after this, right? What's interesting about that is they're going to have a plan to replace this rather quickly, or to address student loans quickly, if, to your point earlier, Rabih, if they want credit for the win, right? Because if all you do is create chaos and then your presidency is over and then the next regime takes over and then they're going to this happens
They're
all the
gonna bring
time.
it back,
They're going to bring it back, or they're going to make changes depending on who takes over. But this stuff happens all the time, right? Where presidents take credit for past presidents' policies. This happens literally all the time. But to your point, they're going to have to make a move. Taylor, actually, our resident student loan expert, I actually just talked to him yesterday, client specific question, and he said something interesting about the student loans. He said the current administration wants to do something about student loans just as much as Biden did. They just want credit for it. So something is going to happen here. I haven't heard. I don't know if you have. Haven't heard any like they're dismantling this. I don't know what they've presented as like an alternative. I think maybe just putting it back to the states, maybe. But this isn't just like you dismantle this with no alternative. I would imagine they're going to have some type of plan in place, or at least I would hope so.
Yeah, you would hope so. I don't think we're at that stage right now. If I understood correctly, what I'm still trying to understand the U.S. legal system, but it seems like there's still questions about the validity of the executive order and whether it's going to go through, simply because to do such a big move, dismantling a big department, requires 60 votes in the Senate, and Republicans don't have 60 votes as currently. So we'll see whether that will go through, or the judicial system will interfere and block it, and we'll just be in a paralyzed position. More updates on that on episode 501.
Yeah, the saga continues.
Yeah.
For what it's worth, what they're saying is most logical. They're quote unquote, the experts are saying the most logical agency to take over handling the debt would be the Treasury Department, since it's already kind of in the role of collecting past due debts from Americans. But that seems a little bit of a...
Should give it to the IRS. Imagine the IRS is like,
yeah,
pay
exactly.
your taxes and your student loan.
I mean, I think what this means is, Rabih, if there's any year to not pay any debt, especially government debt or your taxes, this might be the time. This might be the year to try it. Just give it a shot, see what happens. Okay, Rabih, anything else? Any other final words on any of this?
No, I hope you guys found this as entertaining as I did. It's
Yeah.
really nice.
I realize why Jay Powell listens to the podcast, because you're the only one that watches his press conferences.
We're here for each other.
Yeah.
That's all I'm going to say.
He's our only listener and you are his only watcher. Yeah, I like this. Speaking of executive orders, Rabih, I heard there's another executive order to get everyone to come to the greatest summit of all time, being the Dentist Money Summit in June in Park City. Did you hear this?
Yeah, it's so popular, it might be passed into a law too.
Yeah, there you go. We are getting worse and worse with these transitions, but we would love to have you out to the Dentist Money Summit, June 20th and 21st. I just did an interview this week with Carl Richards. That'll be coming out here the next couple of weeks. One of our main stage speakers, absolutely incredible. He wrote for the New York Times. We have him along with many other speakers, the best speakers I've heard, the best speakers, all the best kinds of speakers will be coming to the Dentist Money Summit. We'd love to have you out. If you have any questions, check it out, dentistmoneysummit.com. Come hang out with us in Park City. Rabih, thanks for being here. Everyone, thanks for listening. For now, that was our 2 cents. Till next time, bye-bye.